As the dollar heats up, we've been watching it continue to rise. Currency hedged ETFs are too. Here to discuss why they can be potentially valuable tools for investors is Eric Balchunas, senior ETF analyst at Bloomberg Intelligence. So how do these work and what are some of the popular ones?
Right. So the one to watch right now, DBEF. This is basically going long international developed stocks and then neutralizing the currency. So as the dollar gets stronger, these ETFs are just beginning to surge, right? So DBEF is up 4% in the past month. EFA, which is the unhedged version, is flat. So you can see the chart there. Here's why. If you're an EFA, those international stocks are up 4%. But when you convert the gains to dollars, you get less of them, and that just evaporates the 4%. This is why these things were such a big deal 4 or 5 years ago, but the trade stopped working. So there's some
because the dollar was
weakened.
Going down, right?
Yeah, but now that it's strong, and there's a new batch of these out that are called dynamic hedging, just for people who are like, well, I don't know when to go in or out. These do the hedging for you. So WisdomTree has one, WWDYM, which does the same thing as DBF, but it changes the hedging based on three different signals.
So it's not hedged in one direction, in other words.
Well, it's 50% hedged right now, and it will go up as the dollar goes up. It won't pop like a DBEF, so it's only up 1% in the past month compared to DBEF, but it will do the job for you if you just want a hands-off.
Okay, super quickly. Normally, emerging market currency hedged ETFs are not that effective, but that could be changing.
Yeah, and this EM sell-off that we're about to see, DBEM is flat, whereas EM's down 2%. They're a little less effective because the cost of the hedge is what the rates are in those countries. And unlike international developed, where the hedge is free because rates are nothing, here the rates are about 3% on a weighted average. That's down from 4.5%. So the cost of your hedge is much less than it was, but you still have to overcome that 3% cost of the hedge to start gaining money. So they've been less popular in emerging markets, but they do act as a volatility lessener, and that's sort of a side purpose.